Good evening, ladies and gentlemen. Welcome to Corporate Connect webinar, jointly organized by SIAS and supported by SGX. Today, we have with us Mr. Geoff Howie, Market Strategist of SGX, to share with us on REITs Market Outlook, followed by Elite Commercial REITs presentation and Q&A. Without further ado, let's welcome our first speaker. Over to you, Geoff.
Okay, thank you.
No worries.
Good evening, ladies and gentlemen. A very, hang on, the co-host says, yeah, start my video. Okay. All right, I assume everyone can hear me and see me, and it's a very good evening to you all. My name is Geoff Howie. I'm the SGX Market Strategist, and really wish that I was with you in the SGX auditorium this evening, but instead where I'm coming from my black and white home in Chipby Gardens. So I plan to take about 15 to 20 minutes or so to provide you with a quick overview of our REIT market. I must point out that this presentation is designed to be purely informative with recent observations that are predominantly on the REIT market and is in no way providing investment advice. So S-REITs have been a pillar, a big pillar when it comes to the growth, the turnover and the overall span of the Singapore stock market. The S-REIT subsectors like data centers, high-tech buildings, healthcare, industrial properties, warehouses and depots have been very important this year, not just to the REIT sector, but the overall market as a whole. Since, I guess, 2002, Singapore has grown to be one of Asia's largest retail and property trust markets. We now have more than 40 property trusts that consist of something like 35 REITs, 5 stapled hospitality trusts, and 2 business trusts. Looking back over recent years, I think it was year 2006, which was really our watershed year. It was the year we doubled our number of REITs to listing on SGX. We had the staple trust, the first staple trust, which is still listed now, and we also doubled the combined market cap of SGX listed trusts that year from 23 billion to 23 billion from 11 billion back in 2005. So the combined market cap of the S-REIT sector is near 100 billion. Note on that slide we're saying 95 billion, but that's because we that cut was taken at the end of October and yet to account for the CapitaLand commercial trusts, that big units that became part of CapitaLand integrated commercial trust. So the S-REIT sector size is near 100 billion, and that represents around 12% of our total market capitalization, which stood at around 800 billion at the end of October. However, these 40 trusts, both last year and this year, have contributed to around 24% of our day-to-day turnover. Hence, the impact on the turnover on a day-to-day basis is double that of what the REITs bring to the overall market value. And the S-REIT sector is very much recognized as a global REIT hub, and you're going to hear a lot more from Charlene about that tonight. But I should say as many as 18 of the trusts exclusively invest in property assets outside of Singapore, with 19 of the trusts investing in properties in both Singapore, I should say 18 in both Singapore and outside Singapore, and the remaining 5 REITs investing purely in Singapore. This includes as many as 10 REITs with properties in China, 7 REITs with properties in Japan, 25 that are in Singapore, and as many as 6 in Malaysia. The trusts are also very highly diversified across property types, with a balance across retail, industrial, office, and hospitality properties, in addition to, I guess, multiple REITs that are investing in healthcare-related properties and specialized property assets such as data centers. This year, Keppel Data Center REIT, with 48% of its rental income coming from internet enterprises, has been the strongest of the S-REIT sector. And Keppel DC REIT has also been amongst the 30 most strongest performing REITs across the world. Much of the focus this year has obviously up to this point been on internet providers, and Keppel DC REIT did highlight that its internet enterprises under the trade sector makes up close to 50% of the portfolio's rental income. And in that FY18 AGM some time ago, the CEO did note that their policy is not to share tenant names rather than the trade sector due to the confidentiality to the location of data centers, which is obviously very important to the tenants. And furthermore, he stated that the clients do include hyperscale cloud providers that are now amongst the largest companies in the world, and the risk of default very low. Should also mention Mapletree Industrial Trust, which has also upped its exposure to high-tech buildings and data centers to close to 50% of its overall portfolio with high-tech exposure. And that has also been among the top 50 performing global REITs this year. Meanwhile, globally, of course, we've had hotel REITs down close to 40%, retail REITs down 25%, and office REITs down 20%. But a lot of that, I guess, did change somewhat today. Today we saw the STI gain 3.7%. That was its strongest session since the 7th of April. Firstly, I guess it's the trial results of Pfizer and BioNTech has been very consistent with what the WHO Director General stated back in early October, that a vaccine may be ready by year end. I think going into this last quarter of the year, there are 170 COVID-19 vaccine candidates under development, and 15% of those were in the human trial phase. So today, we've seen very big moves, and it's been all about three things: rotation, rotation, and rotation. Within the REIT sector, investors have rotated today outside of Parkway Life, Keppel DC REIT, Mapletree Logistics Trust, Mapletree Industrial Trust, and Fraser Logistics and Commercial Trust. Those 5 trusts, they averaged 6% declines today, but that was after they all gained, double-digit gained in the 2020 year to 9th of November, with average total returns as high as 27% for that 2020 year through to the 9th of November. And then the rotation saw them fall 6% today. But meanwhile, those 5 hospitality trusts, ARA, Ascot, CDL Hospitality, Far East Hospitality, and Fraser's Hospitality, they gained strongly today. They averaged 11% gains after averaging declines in total return of close to 40% in the 2020 year to 9th of November. Hence, we saw that strong rotation in the performance. I guess in terms of overall performances, the trusts of the REIT sector, they have averaged a double-digit decline in the total return to 2020, somewhere around the 15% mark, and that is in line with the 15% median decline of the more than 800 global REITs in the year to date. Longer term, the annualized 10-year total returns for the S-REIT sector that have been listed for the duration is around 6%, and that compares to around 4.5% for the global REITs. I guess over the past 10 years, the 5 strongest REITs that were listed for the duration, they included Mapletree Industrial Trust. I think annualized total returns were around 18% through to the 9th of November. Mapletree Logistics Trust with 15% annualized total returns. Parkway Life with 15% annualized total returns. Centres REIT 10%. I think Fraser Centrepoint Trust annualized returns were also 10%. So annualized total returns varying from 18% to 10% for the 5 best performers over the last 10 years. And those, of course, were 3 of those 5 were, of course, amongst our strongest REITs in the 2020 year through to the 9th of November. Our REIT sector is also very highly competitive. For the broader REIT sector, we should point out that on the valuation front, the average valuation for our REIT sector is 0.95 times in its price to book. And that's in line with the median price to book ratio of all the global 800 REITs or so, which is also 0.95 times. And this year, of course, we've seen these initiatives to help support capital management, Ministry of Finance, IRAS, the MAS, they announced these new measures for S-REITs, you might recall, back on the 16th of April, including distribution timeline extensions to qualify for tax transparency. Leverage limit was raised from 45% to 50%, and there was a deferring of the implementation of that new minimum interest coverage ratio requirement through into 2022. The real estate developers, the operators, the managers, they have had to grapple with exogenous declines in property sales and leases this year. And Hence, we've seen prudent capital management continuing to be a key theme underpinning the sector. And of course, the ability to recycle assets and diversify their property pipelines and portfolios are other more, I guess, subsector specific drivers going into 2021. Yeah, it was interesting too, in terms of the retail market participation. After strong performances in 2020, net retail inflows did back off the S-REITs in the 2020 year. I should say after those strong performances in 2019, with 2020 hindsight. Back in 2019, the S-REIT sector was up around 25%. Global REITs were up around 20%. So after those strong performances, the inflows did back off somewhat into the beginning of this year through to 5th of March. And then we saw that ensuing broad market weakness, saw those retail inflows return and more focused on the larger capitalized REITs trading at relatively lower prices. Net retail inflows have been consistent somewhat over the comparatively sharper partial recovery from the 23rd of March through to the 9th of June. And then all those consolidating market conditions from the 9th of June through to now have seen consistent inflows as well, while the net institutional flows have been a lot more reflective of the individual REIT performances. The growth of the sector is really important too. I don't want to harp on too much because this is Xiaolin's night and Elite Commercial's night, but 20 and have been continuing. There are multiple instances of growth this year, continuing this year. In the October month, we saw 5 S-REITs: Aro Logos Logistics Trust, Mapletree Logistics Trust, Suntec REIT, and Lendlease Global Commercial REIT, with 4 of those 5 REITs that did announce or propose property acquisitions. And those property locations spanned Australia, China, Malaysia, and Singapore. And also on October 19, Elite Commercial REIT proposed the acquisition of 58 quality UK commercial properties for, I think it was £213 million, that are primarily leased to the UK government, increasing its overall exposure to London to 14% of the enlarging portfolio, which no doubt Xiaolin will share with us very shortly. But I guess what the good implication of the growing of the portfolios is the S-REIT sector does very much punch well above our weight in the world, or the overall size of Singapore's REITs to the global REIT market, to the global real estate stocks. Singapore maintains more than a 3% weight in the FTSE EPRA NAREIT Global Index. So that's approximately 8-fold its 0.8% impact in the FTSE World Index. And 1 in 20 of all the FTSE EPRA NAREIT Global Index stocks are actually traded here in Singapore. Inclusion into the FTSE EPRA NAREIT global indices is highly supported by REITs, and mergers are also a means to this. REIT mergers are believed by the industry to lead to index placement through bigger size, more liquidity, and potential re-ratings. So we've seen joiners in the FTSE EPRA NAREIT index series this year as well. Over the last 12 months or so, we've seen Keppel DC REIT, Fraser's Centrepoint Trust, Fraser Logistic Commercial Trust, Manulife, SIAS REIT, Ascot, and Parkway Life REIT have been there. And what's important too for the issuers is that there are funds and ETFs tracking these indices. There are 28 ETFs that are benchmarked against the FTSE EPRA NAREIT Global Real Estate Index Series, with about $12 billion in assets under management. And more broadly, back at the end of 2017, FTSE Russell collected data from eVestment data for institutional assets and Morningstar data for retail mutual funds, insurance products, and ETFs to estimate that there was around $340 billion tracking the FTSE EPRA NAREIT Global Real Estate Indices. So importantly, REIT sector's popularity in Singapore, it has grown significantly, with the sector obviously known for the high yield and the low volatility. As we see in this slide, that the combined market value of the S-REIT sector, it has grown at a very strong compound annual growth rate of 15% over the 10 years ending 2019. But as expected, not every single year saw growth. For instance, you can see here in 2015, the combined S-REIT sector market value is down 8% from 2014, and compared to 2019, the 2020 market value combined is currently down a similar multitude. The combined entity of CapitaLand More Trust and CapitaLand Commercial Trust, it did begin trading as CapitaLand Integrated Commercial Trust on the 3rd of November. And according to the REIT manager, the new name reflects its investment mandate to invest in quality income commercial properties, including those primarily used for retail and office purposes, located predominantly in Singapore. But the combined entity has now a total portfolio value of 22.4 billion and a market cap of 11.4 billion. And that market cap makes it the largest REIT on the SGX. And the merger of those two obviously made way for Keppel DC REIT to join the STI on the 19th of October. So with the addition of Keppel DC REIT in the STI, the indicative weighting of all 6 S-REITs in the STI is now close to 15%. And the STI reserve list now consists of 4 stocks, of which 3 are REITs: Fraser Logistics Commercial Trust, Suntec REIT, Keppel REIT, and I think the 4th stock in the reserve list is Netlink NBN Trust. So as we said, high dividend yields and low volatility is an important aspect. I guess high yield is an important aspect, but distribution growth, it has been as well, but less of a focus following the granting of the distribution timeline extensions this year to qualify for tax transparency. But nonetheless, with US 10-year notes yielding 0.8% and the FTSE ST REIT index yielding, let's say, 4.8%, then the difference is close to 4 big percentage points or 400 basis points. This year, in terms of volatility, look, the big US dollar liquidity strain was the pinnacle for the excessive volatility we saw this year, and for most asset classes back in late March. And globally, REITs saw a lot more volatility than usual, and that was predominantly because of the spillover from concerns on the ability for US mortgage REITs to service their leverage and restructure loan obligations. So mortgage REITs are not actually traded here in Singapore, but the mortgage REITs led much of that volatility. The FTSE NAREIT Mortgage REIT Index declined 60%, that's 60%, in the 2020 year to 24 March, with its 30-day volatility soaring to 120% on that day. By comparison, our IAG S-REIT Leaders Index had declined some 28%, half that, with much less volatility. I think 30-day volatility at 60%, half the volatility that we saw globally. So REITs do have a track record of being, I guess, a resilient asset class in terms of price performance, and this has generally seen less volatility than the sector's past. I think a strong testament is amidst it all, back in the middle of the year, we saw the annualized volatility of the US EPRA NAREIT index, FTSE EPRA NAREIT index at 45%. Australia was 43%, Japan was 41%, developed Europe was 37%, but Singapore itself was 30%, the lowest of those 5, and its 5-year annualized volatility is something like 14%. And there are also structural reasons for less volatility. S-REITs are, of course, highly regulated, providing investor protection. External managers must have this 5 years of track record. More than 90% of the taxable income is distributed to investors under normal circumstances. And there is that gearing limit of 50% for S-REITs. Yet they currently average a gearing ratio of 36.6%, which is well below the gearing limit. And of course, more than 75% of funds deposited into should be deposited into already income producing assets. So correlation, I think, is really important too, particularly this year, because we've had so much of the global markets driven by staunch sector drivers. US listed REITs currently make up 48% of the weight of the FTSE EPRA NAREIT Global Index, and have played a key role in the broad REIT trends in 2020. One of the more recent sub-trends, for instance, I guess global REITs have been supported somewhat by the Fed Reserve's policy of 2% inflation targeting in the US, particularly between the 26th of November last year and the 16th of September this year. Policy signalling on the later date suggested, however, that there'd be more moderate inflation overshooting after years of undershooting, and that moderation per se of, yes, allowing inflation to overshoot, but perhaps not as much as the market thought, saw a little bit of the bid tone come out of the REITs after that. REITs also function as an inflation hedge to US investors, and the aforementioned period, that 26 November to 16th September, saw the total return of the S&P 500 REIT constituents perform in line with the S&P 500 equal weighted index. However, since then, the REIT constituents had been outpaced by the equal weighted index by as much as 5%. Nonetheless, we continue to see increased investment flows, and we continue to roll out products relevant to the sector. Before we launched REIT futures in the middle of the year, we launched 3 REIT ETFs over a quick 12-month period between October 2016 and October 2017. Now, the combined assets under management of the Nikko AM Asia ex Japan ETF, the Lion Phillip S REIT ETF, and the Phillip SGX APAC Dividend REIT ETF have increased from $388 million at the end of 2019 to, as you can see, $460 million as of the end of September, but back down a little bit to $448 million at the end of October. As I mentioned, the REITs had not kept up pace so much with the S&P 500 equal weighted index following that last FOMC meeting on the 16th of September. Well, not the last, this the second last. Look, I won't go on too much, but within the regional REIT industry, I should say that prudent capital management, as we said before, the ability to recycle assets, diversified property pipelines and portfolios do remain the key sector drivers in 2021. REITs are still going for growth and expanding portfolios, as you're about to hear. And I guess assets for new listings going forward in terms of the IPO pipeline, they will still be driven, I think, from markets like Europe and the US and Asia Pacific. And we do expect, of course, to see new asset classes in new listings as well, we hope. I mean, student accommodation has been talked about for some time, as is the China recovery. And the REIT market is very much, I guess, supporting the global growth ambitions of Asian real estate sponsors. So I hope that was a good quick overview. As we said, a lot happening today. I think ARA Hospitality Trust was the strongest of the sector. I think it was up as much as 20%. But as we said, it's been one of the worst performing REITs this year. And it was very symmetrical today in terms of those rotations. The biggest decliners in this year saw some of the biggest gains, while the biggest gainers had seen some of the biggest declines. Nonetheless, I'll finish off here, and thanks very much for your time. I hope you very much enjoy the presentation with Elite Commercial Trust coming up very soon.
Thank you, Geoff. Next up, we're pleased to have with us today Ms. Charlene Wang, Chief Executive Officer of Elite Commercial REIT. Ms. Charlene, please.
Hi, thanks, Christine, and thanks, Geoff, for the excellent presentation. Ladies and gentlemen, thanks for spending time with us this evening. I'll run through a brief introduction of Elite, what we're doing, and we'll join with my CFO, Joel, CIO, John, and also my IR later for more question and answer session. So let me just share the screen now with everyone. Okay, we're here to present to you Elite Commercial REIT. We are actually the first UK-focused Singapore REIT that is actually backed by the sovereign tenant, which is the UK government. We are actually listed on the 6th of February this year, just before the onset of the COVID-19 pandemic. But I think the REIT has been performing strongly. All our assets are 100% leased to the UK government. So almost all of them are on freehold land with one property, which is on the leasehold land, which has more than 230 years balance leased. And all of these assets are actually fully occupied. So where are these properties located? If you look at this map, this 97 assets that we have in our portfolio are located in all over the UK, and mainly at the lighter grey area, which is the more densely populated areas. Well, I think that is to do with who is our tenant. Our tenant is actually the AA credit rated UK government. All the leases are signed with the Secretary of State for Housing and Communities and Local Governments. However, the key occupier of these assets is actually the Department for Work and Pensions. So DWP, in short, is actually responsible for the country's welfare, pensions, and also child maintenance policy. All the leases are actually on full repairing and insuring leases. So basically what we in Asia commonly term that as a triple net leases. In addition to that, all the leases are actually come with a built-in rental escalation, which is linked to the CPI index. And it is actually having a floor and cap of 1% to 5%, meaning that every year, if the inflation drops below 1%, we have a minimum of 1% increase compounded. And if it's above the 5%, it will be capped at 5%. The increase will happen in the year 5 of the leases, which means it will come in 2023. Well, the portfolio is actually used by DWP, which is very crucial to the social fabric of the UK. It provides over 20 million claimants with benefit in their financial year reported in March 2020. And of course, with the onset of pandemic, this number has increased as well. The total benefits that was actually provided to people for F1 2020 amounts to £191 billion, and on an average, which means that it's more than £9,000 per claimant per year. The 97 assets that we have are used mainly as the front offices and also the back offices, commonly known as the front of house and the back of house. 80 assets in the portfolio are front of house offices, which means they are something called the Job Centre Plus and also ancillary services. Now, Job Centre Plus are places whereby they have got work coaches to help people who needs to get back to work, will help them to claim on benefits, retrain them, and also bring them back to the workforce. The Job Centre Plus also provide other services such as the pension services, which is to the older generation, and definitely in UK, there is an aging population increasing yearly. So a big portion of the services is provided to pensioners. There's also something called the child maintenance services, whereby supports is being given to cases where a child is in require of supports, or families that has got requirements for support. Some of the buildings also come with medical examination centers. Of course, these are not the GP doctors, but these are actually housed with specialists to be able to assess the disability of the individual who is claiming on disability claims. 17 of the assets are actually back of house offices, and these provide things like the development of the Universal Credit Program, which is the online program for payments of DWP. It also houses things like the finance and accounts, claims processing, call centers. One of the buildings that we have in Glasgow is also the largest, not the largest, but the only passport center in the whole of Scotland. So that is what the properties are being used for lately. Now, apart from all that what I've mentioned, fundamentally, the assets are actually very well located and predominantly freehold office assets. Now, these assets are also 100% occupied, and they are mainly located in the town center locations. The government specified that the buildings needs to be within walking distance to public transports, and it pledges to make sure that every citizen will be able to reach a job center plus within 25 minutes from its public transports. Hence, the portfolio is not only close to bus stops and train stations, but it is actually also very close to education, health service, medical facilities, F&B services, and other amenities as well. So this is just some of the statistics of where our properties are located in relation to all these. So much about the property. Let's talk about who are the sponsors for Elite Commercial REIT. There are 3 sponsors for this REIT, namely Elite Partners Holdings, Holy Group, and also Sunway RE Capital. Just in brief, EPH, which is Elite Partners Holdings, is actually a fund management company and is backed by a team of PE and REITs experts, experienced people who actually started this fund and also many other funds that's under management. Holy Group is actually a very experienced and extensive developer, and they're also related, doing the construction related business. They are one of the major sponsors for Viva Industrial Trust back in 2013 when it was IPO. Sunway Group is actually one of the largest conglomerates from Malaysia. They are in property development, property investments, and of course REITs and other activities as well. Sunway also has their own asset, another REIT called Sunway REIT, which is listed on the Bursa in Malaysia. Now, since listing in February, I think we have gone through a very challenging time when the whole world is fighting under this COVID situation. But we are quite pleased to say that Elite Commercial REIT has been very resilient, and we have actually performed well and performed way above what our promises during the IPO time in terms of our financial matrix. So, namely, things that are of concern for investors such as DPU, cost of debt, and also leverage has all been performed much better than our IPO stated promises. Now, in terms of our unit pricing, we closed 3.7% above our IPO price during our debut day. And since then, we have been actually trending well above the S-REITs index and also the STI index as shown in this graph here. So the pandemic situation has been putting a lot of stress across the world in terms of all the economic environment. We see unemployment rates going up in all the countries. Definitely UK is not being spared as well. So if you look at this chart here, since the lockdown in UK happened in March, there is actually a sudden surge in terms of the claimant counts to 2.7 million by August 2020. This particular surge has actually also causes the UK government to pledge that they will be putting a lot more resources into DWP and also employing more work coaches to help to get people back into the workforce. With this very uniquely countercyclical occupier in our buildings, we can see that we are able to report almost 100% of rental collection within 7 days from our due date. So this is actually because the government is able to pay the rents in full and on time. So the REIT has actually also been working extensively on its asset management work since listing. Other than just collecting the rental collections, we have been talking to the government. 2 of the break options has been either been extended or the options has been actually worked out to be removed. So we will continue to work on our break options, and hopefully this will actually bring an uplift to the valuation of the portfolio. Now, people have been wondering during this particular pandemic situation where the managers are sitting here in Singapore, how are we managing the assets in the UK? Other than the properties being on FRI leases, we have actually very pleased to be able to say that we recruited experienced local asset managers before the COVID happens. Hence, we do have people on the ground that has been working with DWP and has extensive work experience with the tenants over the past 15 years on their estates. So direct dialogue and regular dialogues has been happening with the tenant and also with the government property agency. Well, this is to show that, you know, we have got a very unique and differentiating strategy here. On the back of a similar kind of credit backing, which is the UK government leases and UK government backing, we can see that actually comparing to a 10-year gilts, the yield that Elite Commercial REIT is yielding is almost 690 bips above what the UK government 10-year government bond is yielding today. So with this, I guess it would be timely for me to just share with you some of the interesting activities that we have recently announced. I think Geoff has mentioned this as well, is that we have actually announced a major acquisition on the 19th of October. So this particular acquisition builds on our existing strategy, and we are proposing to acquire 58 commercial buildings, which is primarily leased to the UK government and are on long leases with a WALE of 7.4 years from our sponsors. So this is actually part of the ROFR pipelines that was given to us during IPO stage. The agreed value that of this particular portfolio is £212.5 million. And we have actually structured the transaction with completion in mind, hence negotiated on paying the vendor a portion of the consideration in the units for the REIT. So we are able to fund up to 89.4 million of the acquisition via consideration units, which will be paid to unrelated third-party vendors who own the assets under a fund at a minimum price of 68 pence per unit. This particular transaction sees some interesting points. It will actually bring about London assets which we do not have in our current portfolio. It will also introduce new tenants, which is also led to the government in this particular portfolio as well. So I guess before we go into a little bit more about the transaction, the rationale for this particular acquisition that we're putting forward is, one, it will extend the REIT's profile to UK sovereign tenant. So other than DWP, which is our main tenant, we are introducing another 5 government tenants here into our portfolio. We are able to produce a stable cash flow and the CPI index growth link growth with this particular portfolio, because majority of it is also linked to the uniquely countercyclical occupier, which is key. Now the portfolio will see an increase in London assets, which is something the manager believes has got much higher potential than any other of the cities in the UK. About 36% of the assets to be acquired will be from London. The AUM of this acquisition will increase total REIT AUM to almost 1 billion Sing dollars. This is actually quite an important and crucial point for the REIT. We hope that with this particular acquisition, we will be able to increase our market cap, free float, and hence aids in our liquidity of the stock as well. The transaction is DPU accretive. On our base case scenario, we are forecasting at least 3.2% DPU accretion. So that is attractive to our existing portfolio as well. So I'll talk about the increased tenant base here. Now, the tenant other than DWP, which will come into the REIT's portfolio, includes the Ministry of Defence, the National Records of Scotland, which houses all the statistics of Scotland, the courts and the tribunal services, whereby these is actually very specially fitted courtrooms, which is something that will be very essential for the government as well. Of course, we also see the inclusion of some environmental bodies, such as the Welsh government-sponsored Natural Resources of Wales, and also some other environmental agencies. The key tenant is still DWP. Now, as mentioned earlier, there is an increase in the unemployment claims. So in line with that, the government has actually pledged that they will double the amount of work coaches on the job centre class in the UK. Currently, it employs about 13,000 work coaches. By 2021, they will increase this to about 27,000 work coaches. With this increase, it also means that the shop centre plus requires more space and to house these employees. And these are not temporary employees. So these are people who will be required to help people to get back to the workforce. Hence, the need for the assets is much required, more than ever before. We mentioned that the properties are actually very much all around UK, but with the new introduction of London. So 36% of the new assets are actually located in London. London has got higher value, growth potential, and also redevelopment potential and liquidity as well. Now, all the London assets that we have in this new portfolio that we are acquiring are 100% freehold, and they are on street 10-year leases from 2021, which were expired by March 2023. London is actually the city centre of the whole UK, and due to the pandemic, you can see that London has actually got a much quicker increase in terms of unemployment to almost 130% from January to August, as compared to the regional parts of the UK. So London is actually a crucial portion of the area that we would want to see our portfolio expanding to. So in terms of the assets that are located in London, it's actually quite well spread across north, south, east, and west part of London. And we would like to just show you just two examples of the assets that we are acquiring in London. Now, this is quite similar to most of all the other assets in our portfolio as well, in terms of the location, in terms of accessibility. So the first example is actually our Medina Road, Kinsbury Park asset. This asset is actually very close to the Emirates Stadium, which I think people will be more commonly known as the football stadium for home stadium for the Arsenal team. It is actually just about 2 stations away from where King's Cross is. Now, the rental that we are actually collecting for this particular property is £18 per square per annum. And if we just compare it to assets that are close by, and or even assets that's at King's Cross, which is currently reporting at about £65 pounds per square foot per annum, or even higher. So definitely there's a lot of potential in these assets. Now, the nearby locations of this particular assets has got retails and leisure amenities. It's also got high potential for redevelopment into other uses, such as the residential areas. Now, if you look at the assets, it's only a 2-story building, so there is actually a lot of potential in it. Now, the next one, which is actually in Stratford, this is actually in the eastern part of London. It's actually the second most significant business location right after Canary Wharf. The property, it's about 3-story high, and there's definitely potential for building higher buildings here because of the neighboring buildings that you can see in the picture. Now, this particular asset is located very close to where the London Stadium is, where we had the London Olympic Stadiums. It is also very close to the Westfield Shopping Centre, which is the largest shopping centre in London. It's actually located right across the Crossrails, and also other stations that is tube stations and train station around the area, which makes it actually very accessible. So similarly, this actually got a very huge potential for future use as well, should the government decide to move the way in when the lease expires. So just a quick recap of this acquisition then. The acquisition will increase the portfolio size to about £532 million, which is close to 1 billion Sing dollars. This will actually increase our market cap to more than 57% on our base case scenario as well. So hopefully with this, we are able to increase the free float and liquidity in the stock and get it more attractive to investors. Under our base case analysis, the the transaction will yield a 3.2% DPU accretion. And if you look at the yield on the properties itself, prior to this particular acquisition, we do not have any assets in the London location. So comparing the regional assets, this portfolio actually has yields 70 bips higher than our current portfolio. And the London assets is yielding at a very healthy level of 4.3%. So the managers will strive to ensure that we will continue to acquire assets that are that is actually benefits the REIT itself. So just quickly coming to this portion of the acquisition, I won't bog you down with the details of the financing. However, a few points that we would like to raise in terms of the structuring of the transaction is that because it's a related party transaction, the assets although are not owned by the sponsors, are actually managed by one of the sponsors. Hence, we actually have gotten two valuers to look at the valuations of the assets, and the agreed value is based on independent valuations. The structure has been done in such a way that it has got deal certainty, and the assets are actually being owned currently by 5 unrelated third parties vendors. One of which we are actually highlighting here is actually a leading global reinsurance company from Europe, known as Partner Reinsurance. So with this transaction, Partner Re, which is our current shareholder, will increase its stakes to close to almost 21%. So which means it will become the largest, most substantial unit holder of Elite Commercial REIT. Partner Re is a A+ rated, S&P rated company, which has got a global diversified reinsurance firm. So it is actually owned by the Anali family, and it's actually a subsidiary owned under the Exor Group. So Anali family does actually owns other well-known brands that I guess people will be more familiar with, such as the Ferrari, the Fiat, the Ferrari car that we know, and also the economists that I think most of the investors would be very familiar with. What Partner Re has demonstrated is that they are actually a long-term supporter, and they're confident of the REIT growth. Hence, they actually has went well above what they need to do. They provided the REIT with actually a voluntary moratorium not to dispose the units that they receive in considerations for 6 + 6 months, which means that for the first 6 months, it will be 100% locked up. And for the next 6 months, 50% of the consideration units that they will receive will be locked up. So we do see that there is actually the alignment of interest within the inclusion of Partner REIT as the substantial unit holder to Elite Commercial REIT. So I guess just a quick summary of the transaction. The total cost of this transaction is £218.5 million. We will be funding, under the base case scenario, we'll be funding it through borrowings, of course, at 96 million. The consideration units of 9.4 million, as mentioned. We are looking to do an equity fundraise of 13 million, should the market be conducive. That will bring the DPU accretion to 3.2% and the aggregated average leverage of the REIT to 37.7%. So with this, I think that concludes the acquisition portion. However, just to share a little bit more with investors on what is our future growth strategies. The REIT will continue to grow. It's actually the manager's strategy to look into acquisition both on market and off markets. The UK definitely has a very robust and also very active acquisition market, investment market. Although we see that the COVID pandemic has caused the investment sentiment to reduce in the UK. However, assets that actually has got very strong government tenants or security in terms of of rental payments definitely has got its place in investors' heart. So despite the pandemic situation, even during the hard lockdown during the UK in April and May, we do see assets that led to the government being transacted in the country as well. So we will continue with our strategy. We will look at more commercial assets to lease to the government tenants as our focus. We will also actually diversify our tenant base. So providing as tenants that actually provides the social infrastructure facilities is something that we're looking for. Hence, like the NHS, which is the National Health Services, the education sector, the HMRC, which is tax authorities, will be potential tenants that the REIT will look into acquiring those assets that led to these tenants as well. At the same time, we will continue with our lease management activities. We will be continuing to discuss with DWP on all the break options, and hopefully with the ability to remove break clauses and lease extension, we will be also able to show the increase in valuations and therefore providing an increase in that headroom and growth for the REIT. With that, I think I come to the end of the presentation. We'll probably open this up for a Q&A session. Thank you.
Thank you, Ms. Sheldine. Okay, so now moving on to our last segment, we will have a Q&A session. If you have any questions in the comments section below, and due to time constraints, we would like your understanding that not all questions will be addressed. So without further ado, we would like to invite our moderator for this evening, Mr. Richard Dyerson, General Manager, Planning, Education and Research of SIAS, as well as the panelists from Elite Commercial REIT. We already have Ms. Sheldine Wang, Chief Executive Officer, Mr. Joel Chia, Chief Financial Officer, Mr. Jonathan Edmonds, Chief Investment Officer, as well as Ms. Carissa Liu, Manager, Investor Relations.
Sheldine, thank you everyone, and thank you Geoff earlier for your interesting insights. Actually, we had a discussion just about a week or so ago talking about where the market was going, and at that time we said, well, you should really not be looking at any single counters because it was huge volatility. And true enough, as we made a call, that there's not any one particular REIT that you should be looking at. Is basically the whole portfolio, and that has been changing. And Sheldine, thank you for your interesting presentation. I trust your colleagues are well and safe in UK. These are really unprecedented times, and really the human cost of this pandemic cannot be underestimated. And I wish all your colleagues they're safe and they are safe and well. I just wanted to just kickstart with a couple of questions, and one of the key things that we didn't discuss, and I think which is also on the minds of a lot of people, is that Brexit is still on the cards, right? It should be. I think UK is scheduled to leave the EU officially by the end of the year, this year, unless we decide to do something else. I don't think so. Recent articles have also reported the shifts and relocations of businesses, operations from UK to continental Europe. Technically, what we're seeing is that this could potentially create an oversupply of office properties in London specifically. Notwithstanding that, the existing leases are made to UK government entities. I think most of it are. The case of oversupply may be arguably have less spillover effect on Elite. But this has also escalated by the second wave of the COVID infection in UK. To this end, what is Elite's take on the base and worst case scenarios from Brexit or COVID? Furthermore, what are the competitive advantages Elite yields over its competitors in the UK office space, which allows Elite to tide over these challenging times ahead?
Yeah, hi Richard. I hope you can hear me. I've been
Yes, Jonathan,
as the main as the UK representative to help answer this question. It's interesting that you ask about Brexit, because whilst we were doing, putting the investment strategy together last year, and then on the road with the IPO, most of the questions that came from investors were focused on Brexit. Obviously, the COVID hadn't really appeared on people's radars as a potential threat at that point. The REIT was really designed to, as Shaldine has mentioned, provide stable returns from a counter-cyclical occupier, and what that meant was that, as you say, Brexit, the threat of Brexit, could ultimately see a couple of things. One, a loss of jobs in the financial services sector in central London, as well as in other parts of the UK. And therefore sort of declining rents and occupancy. The REIT portfolio is entirely leased to DWP, and DWP's services include provision of unemployment benefits, amongst other things. So what happens? If unemployment rose as a result of Brexit, then the assets in this portfolio would actually become busier, and it was that sort of counter-cyclical nature that led a lot of investors to support the IPO, because the strategy is so highly differentiated from others, that investors felt that they needed a stock that had a very high level of stability around the income that was coming from the tenant in a potentially negative economic scenario. At that time, that was Brexit, and whilst Brexit actually, as it turns out, didn't look like it was going to be too bad economically, particularly in comparison to the effects of COVID-19. Obviously, COVID-19 has become a reality, and the economic effects have, as you said, are not fully sort of known at this point. What we have seen is a massive increase in, I suppose, the utilization of the assets in our portfolio. Just to put that in context, you've seen about a 200% increase in the number of people claiming on unemployment benefits in London. Across the whole of the UK, on average, it's over 100%, 105% increase in unemployment claimants since April this year. The government's responded by moving, doubling the number of people that work in these buildings who are there to undertake assessment, to conduct retraining, to help people write their CVs, etc. And these are people. This isn't a virtual service that's being provided online. This is a physical, face-to-face requirement where people come to meet the UK government representative. So I suppose what has played out in terms of this strategy so far is that it's because of its differentiated nature that it's really held up incredibly well. It's interesting that both you and Geoff have mentioned the fact that in the last few days there's been a pivot from tech back to hotels and retail, and there's been a volatility in both those areas. Obviously, to some REIT stock benefit, and some have lost out as a result of this. What we've seen with our stock is it's incredibly stable, and that really is what a REIT is there to do. And I think that's what we think this REIT will do, whilst the economic effects of COVID play out, whilst the uncertainty around Brexit plays out. Just simply as it relates to our assets, they're spread all around the UK. They serve a very specific function for the government, who needs properties to be in these locations, and that functionality and location is really what is most important to the tenant. Also, governments are well known for not paying the highest level of rent, so affordability is important, which means that actually across our portfolio, rental levels are relatively low. An example is our asset in Islington in North London, where the rent is £18 per square foot. That compares to King's Cross, which is not very far away, where the prime rent is £80, so 4 times more than in our asset. Across the whole portfolio, both in the existing portfolio and the new portfolio, the average rents run at about between £9 and £10 per square foot. So we're offering highly functional space at affordable levels of rent, which means that the government should continue to operate out of these buildings, for the foreseeable future, and particularly whilst there is an uncertain economic situation facing the UK, which both COVID and Brexit represent. So I think we have a high degree of conviction that the investment strategy that we've set out is appropriate, not just for COVID, but for the potential fallout from Brexit, as well as beyond that. And that's why, I think we're so excited to bring forward this acquisition that is absolutely on point with our existing strategy.
So obviously with COVID, the whole landscape, and one of the questions these people are asking in terms of what are the risk factors have changed, obviously, and what are the main risk factors for Elite REIT?
Yeah, I mean, the main risk factors relate to, I mean, Charlene mentioned this in her presentation, relate to the investment appetite for UK real estate. So what we have seen since COVID is that the investment market, so the total volume of real estate investments that have traded in the UK, for kind of comparing 2019 to 2020, you've seen a fall of about 40%. So suggesting that there are less players in the market. Now, obviously, not many people are looking to make investments in a highly uncertain economic situation. The government has done absolutely everything it can to provide stability across the economy, and particularly in property, where people have been given the opportunity to have rent holidays, to have interest payment holidays. So there's not been so much stress placed on the UK real estate sector per se, particularly in comparison to, let's say, the GFC. So actually the market has been relatively stable, particularly as it relates to valuations. But investment volumes have come down, and that means two things. It means that that there are less players in the market, which creates more opportunity for a group from Singapore with a relatively low leverage vehicle who could potentially go and make acquisitions. But also it raises questions about the stability of valuations, and what's been really important for us is that even during kind of April and May, we saw investment transactions close that were for assets that were let to the UK government. So, if we see assets like ours generating significant investment demand in one of the most volatile economic situations in the UK, again, we feel, quite confident that our assets are stable and really perform in a very highly stressed environment, which is obviously very, very important for a REIT. So I would say that's the main risk factor. The other risk factors that relates to COVID, many tenants haven't been paying their rents, whilst our tenant pays their rent in full and on time. Often we receive our rent before the rental demand goes out, but we are 99% paid within 7 days of the rental demand, which is really unprecedented in these times. I think in sort of June, July, rent collections were down at 60% of what was demanded. So just in terms of rental performance, we really should be seen as one of the best performers in particularly in the Singapore REIT, but in the global REIT market. And our tenant is incredibly stable. So all those factors are really just underline our stability. So yeah, So, but the risk is that the investment market is less strong than it was pre-COVID.
Is that why you're called Elite Commercial REIT?
I wish it were. I mean, I think it you know, in the sense that it displays strength and stability, then I hope so. So we'll live with the name.
Yes, so it sets expectations. You don't, at least you're not housing the elite of London, at least.
No.
No. There was a question from one of your shareholders, from Clifford. Thank you, very great for the presentation. In the MD&A released yesterday, the release mentioned about recent enactment of increase in UK corporate tax rate from 17% to 19% in Q3 2020. Can you kindly explain more about this increase, and why do you say that this event has no impact on income available for distribution to unit holders? Would the DPU payout be affected in a way moving forward with the higher corporate tax rate? Could you explain? Thank you.
Sure. I think this is a very good question, and it's a very good spot by Clifford. Essentially, what happened is that when we were doing our IPO and preparing our IPO prospectus, the government announced that the tax rates would be 17% then. But there's also this announcement that in line with the Boris Johnson government, there's a forward-looking, they might want to increase it to 19%. So when it comes to our forecast and our preparation of statements, we already factored that into the equation. So we have prepared our financial statements, forward-looking ones, based on 19%. So that's why there is actually no impact on distribution. The impact here that we have in the MD&A is actually on our deferred tax liabilities, because from an accounting standard point of view, the deferred tax liabilities have to be adjusted based on the prevailing enacted tax rate. So at the point of preparing the financial statements for the IPO, we had to use 17% on the deferred tax expenses, and we use 19% on the forward-looking tax expenses. Whereas now that now is being cast into stone, the rules have changed from 17 to 19%. What we literally done was to adjust the deferred tax expenses. This adjustment of deferred tax expenses is a non-cash item. There's no impact to distribution because it's not realized. It's just a accounting book entry. So that is the reason why we mentioned very clearly in the MD&A disclosure that this has no impact to our distributable income, because we have always prepared our financial statements on a 19% tax anyway. Yeah.
Okay, I hope that explains Clifford to Clifford exactly what that is. I think there is another question talking about geographical spread of elite REITs in UK. Sheldon, I think you talked a little bit about this earlier as well. Perhaps you could just explain a little bit further, just recap this.
Right, just a recap, I guess if you look at the, let me see which is bigger graph. Okay, this is actually the location. I mean, I guess this dots doesn't tell you much. Well, it's basically on all the major cities itself. But in terms of the breakdown, which is in this particular slide, you can see that under the existing portfolio, there is actually a breakdown of locations. So most of the assets are in the southeastern part of the UK. So that's 24% of that. And there is 1% in east and 4% in 4% in northeast, 1% in Yorkshire and Humber, 6% in Wales, 7% in Midlands, 10% in Southwest, 23% in Northwest, 24% in Scotland. So with the new acquisition, this will be the outcome of the breakdown in terms of geographical locations of the assets. So I hope that's clear enough.
I bet you they are dying to jump on the plane and jump onto the M40 and drive to all these locations.
Oh, we wish we were able to do that as well. I've been dying to do that, but unfortunately, have to wait a little bit.
You know, I mean, I think everyone is, you know, I mean, unlike in UK, we don't have any, I mean, in Singapore, we only have, you know, overseas is right now Sentosa. That's as far away as we can go.
unfortunately, but we just have to hang on.
Yeah, soon. Akan datang. I think one of the key challenges is that, when especially retail investors in Singapore, and the operating conditions may, although UK is, we're a colonial colony of UK before, the operating conditions would differ in Singapore and the UK, which unit holders may rely on the manager to understand and manage the portfolio accordingly. To this end, are there any idiosyncrasies in particular, in areas of opportunities or risk that may not be so understood among the unit holders that you could further explain to them? Can you explain the levels of expertise that you have on the ground, how you manage this? I think you realize that we used to get a lot of requests from unit holders to arrange tours to all the industrial buildings. They don't get that with you over there. So perhaps you could just share a little bit more of things like this, because I think a little bit of assurance and understanding of how you operate on the ground.
Okay, I guess one unique portion of this particular portfolio is, like I've mentioned earlier, they are all on FRI leases, which means the government is responsible for managing the assets, on all the maintenance, insurance, and upkeeping of the building. Now, bear in mind, these are actually government assets. So even for us as the owner, when we need to enter the building, we have to give them 3 days advance notice because of the confidentiality in terms of information in the building that's actually housed in the building itself. So the government actually are responsible, and because the government also have a very high health and safety standard to adhere to, UK is quite unlike Singapore. There are many incidents where we see that people actually sues the government. There was one building that we went to when I saw that the pillar was wrapped up with a lot of this tapes, and then we're telling people of danger. I was wondering why. So I asked the person on the ground, and what they were saying is that 2 years ago, a lady accidentally walked into the pillar, and because of that, she sued the government. So the government is responsible to show that there is a pillar here. So things like these are quite unique and different, I guess, in terms of the cultural, social setting that we have in Singapore versus the UK. So the properties, although they are not new specking, like brand new buildings, it has been actually very well maintained and upkept by the government. You don't see water leakages in buildings that are more than, that has been around for like 10, 20 years old. So these are the level of maintenance that they upkeep to. Now, the government maintained the building. They actually outsourced that function to third-party property managers. Similarly, we sitting here in Singapore have also outsourced the property function to a third-party manager, which is JLL in the first portfolio that we've seen here. Now, with the second portfolio, we'll see an introduction, of course, with the group-related property manager. Now, being so far away, there is also advantage of having some group property managers around to oversee what's really happening, ensuring that the third-party agent is performing the job to where we need to. So the arrangement in our current assets is that the work that is required to maintain the buildings are done by the tenant. The manager ourselves is to ensure that they adhere to all the regulations. So we do have regular checks by our representatives. The leases, the rentals are being collected and on time, and they are reported accordingly as well. So that is the kind of management work that is being managed between here in Singapore office versus in London. And on top of that, like I mentioned earlier, we have the group property management in place, which helps us to talk to DWP together with us. But in times where there is a time difference in our countries, they are also able to talk directly to the DWP. And the person that we have actually has been working on this particular DWP portfolio for more than 15 years. He was actually helping the government as well during the great financial crisis time to look for new space and solve their estate's issues. So it's someone that is very familiar with the government assets and got the ability to get connected to people who needs to be looked who manage the estate on the government side as well.
Okay, I think is there any more last questions? Perhaps if not, I'd just like to just recap it. I think, will you be, in terms of the acquisition, will there be EGM coming up?
Yes.
In terms of timelines, I think, you know, a little bit of, if you just share a little bit of that before we wrap up for the, I think there are no more questions for the end of the day.
Yes, like I said earlier, although the assets are not owned by the sponsors, however, it is actually managed by Elite Partners holding subsidiary. Hence, it actually constitutes a related party transaction. With that, we have submitted the circular to exchange for clearance. We expect that we will be able to hold an EGM, hopefully towards the end of November, if not early part of December, once the clearance has been given by the exchange. And thereafter, we will be able to complete the transaction, hopefully by the middle part of December this year.
Thank you very much, Geraldine. Yes, I think that's a good indicative timeline. I think, thank you very much for sharing. I know the circulars, I came from the exchange. I know we have to set, every circular has to be first approved by the exchange, and they will have a lot of questions to ask. So yes, so we wait for the circular. Thank you very much, Geraldine. Thank you very much, Jonathan. Joel, thank you for your inputs, and I'll hand over. Clarissa, thank you for joining us as well. I'll hand over back to Christine, who will close our session.
Yeah, so thank you, Richard, Ms. Geraldine, Mr. Joel, Mr. Jonathan, and Ms. Carissa. So we have come to the end of today's session. It has been a pleasure to have with us this evening. In case you missed any part of today's session, you can rewatch the session on SIAS Facebook page. Do like our page and check out our website to get more updates on our upcoming investor education programs and initiatives. Thank you and have a great evening ahead.
Right. Thanks, everyone. Thanks, Richard.
Thank you, everyone.
All right. Bye.
Have a good evening.
Thank you.
Time for a beer.
Yes.